this consolidation is like a marriage arrangement. In a marriage in our country, I will use the word husband and wife. Normally, all the cultures, even now it is applicable, the wife need to give dowry. Spelling is correct? D-A-O-W. Wife need to give dowry to. Okay. After the giving the dowry and getting that wedding or marriage is done, who controls who? Husband will be automatically controlled by wife. Even to wear the slipper at your home, you need to get permission from your wife. If this is the case. And to allow your parents to visit your home also, that's a big story. I don't know what the culture in Egypt, but in Sri Lanka, India, story is where the wife need to pay money to husband for a normal arranged marriage. So now when you talk about this parent subsidiary arrangement, the parent is investing on subsidiary. So the parent is something like wife. Subsidiary is something like husband. Now you see another point. Husband have a bank account now. When he is doing business or work, he has a bank account. Wife also has a bank account, to be assured. She has or she may not have. Now, this is the date of, I will say date of commitment, not the marriage. Sometimes even before the conditions are coming. The date of committed, when that marriage arrangement is going to be done, nikah or registration or anything. So this time, the bank account of the husband, who will manage and control? Husband will manage and control. But after this time, this bank account of the money should be pooled with bank account of the wife. And who will have the ATM card and the checkbook and all that? Right. Same story. That the same theory will apply to consolidation. Now we call it this date of acquisition. What do you call that? Date of acquisition. And this period, we call it pre-acquisition period. And this period we call it post-acquisition period. So, until the date of the acquisition, when at the time of acquisition, okay, a negotiation is coming for the parent to buy the subsidiary to arrive the value, how much we should pay to the subsidiary, then you should calculate not only the capital, even the profit that is being generated by the subsidiary. So that's why if you see in this example, we have taken the total of 100 and 1200 together by the 1200 already profit generated by whom? Subsidiary. Now I am going to pay some money, so the subsidiary will argue and ask for money for the profit that they generated. This we call it pre-acquisition profits. So you have this area pre-acquisition profits. But post-acquisition profit is a different story. Now after the marriage, every day, every month when he brings the salary, he cannot do anything. That the wife will control, and then he or she only decides what to do and where to go and what to do, what shopping and then how the saving plan, everything. The wife will do. Same story. After the acquisition, the profits of the subsidiary owned by who? So the post-acquisition profits, this will be owned by clear? So now we have taken this. Next what we need to do is second working. This is the first working. This working we call it calculation of goodwill. That's the working number 1. Working number 2, consolidated results. The retained earnings of the parent and the retained earnings of the subsidiary. How we manage this? So we have parent company and we have subsidiary company as per question. Can we find out from the question how much? Parent company retained earnings. How much? 19,450. Subsidiary company return earning. How much? 1,200. What we need to do now, we should subtract pre-acquisition reserves. How much? At the date of acquisition of this 1,200, how much at the date of acquisition they are having? Entire 1,200 they are having, right? So what we need to do is, we need to remove this out. And please note, this only I have taken here. I have took it out from there and then use it to calculate the goodwill. So, what is the answer? And how do you name this? This is known as post acquisition reserves. Suppose, for example, you have 500 here. That means the remaining return earning. Who is who is this belong to whom? The parent, no? So what you need to do now? You should transfer to parent. The entire amount, whatever the amount, you will transfer. And then we get the 19,450. So this is group. Clear? After finishing this group, now we go to balance sheet again. Now we can prepare the. When we now we can now do the balance sheet. So, any doubt in this before I go to the prepare the balance sheet?
This is the only two step
In this example, but there are other steps will come when you develop the discussion. So now we prepare the consolidated statement of financial position. We have to use the question only.
Okay, but now you told that before, I mean pre-acquisition time, that subsidiary has 1,200.
Correct.
In case if it is more than that.
That's exactly what I told you, no?
Correct. So that particular remaining amount will be post
Acquisition and should be given to parent.
pay.
But now we got the question. We start with assets. We will follow the same format. What is the next line item there? PPE. What I told you, we should do a line by line heading. How much here? 20. And how much here? So, it will be 20,000 plus 900. So I have 20,000. That's the first step. Second one. Investment in Sylvester. Do I need to take it?
No, we already
That already we have ticked off. Now we come to current assets.
3,200 plus 400. 2,600.
What is the first item? Inventory?
3,200 plus 400.
2,000.
3,200 plus 400.
So that means 3,600. Next item?
Trade receivable. 2,500 plus 175.
175.
2,675.
Correct, no?
Correct.
Okay. So that is 2,635. That was
Cash.
cash. How much?
500 plus 124.
25.
5.
So that
So
is
625.
625. Anything else?
This balance sheet, no?
Yeah. This is the balance sheet we are doing.
Consolidated.
Consolidated balance sheet. How much the total?
The total would be 29,100.
6,900.
6,000? We know that we need to take the total of the non-current asset and the current asset. So can we take that total? This is the total asset. 27,000. Now what is the next step there? Equity and
Liabilities.
another equity.
Share capital retained earnings.
Now please remember, even if you don't understand consolidation at all, it's not going, cannot understand, at least you can get 2 marks. How? Share capital in the balance sheet, always only the parent company. Subsidiary company share capital will not take it. I will show you the logic, but I am just telling you this. The balance sheet, share capital, we should only take whose share capital? Parent company. Why? See, 100. This 100, I already taken it. So, colors gone. So, how much is the parent company share capital?
5,000.
How much?
5,000.
5,000. So, I will take it. Return earning.
19,400.
See, this 19,450 we have to take. This answer. Don't take the answer from the balance sheet, take the answer from your working. Because it could change. So 19,450. So that is 24,450, right? Liabilities. What liabilities we have?
Trade payables and income tax payable.
Do we have non-current liability?
No.
No. So we have trade payable. How much?
2,500 plus 200.
2,500 plus 260.
2,760.
2,760. And then
Income tax payable.
tax payable.
150 plus 40. 509.
What is the total?
2,350.
3,350? I don't know.
Yeah,
24,450 plus 3,350. What's the total?
3,300.
That's okay. What is the total? 24,450 plus
27,800.
27,800. That should be. So this is what the very first step in preparing a consolidation. I will recap. I will summarize this step now, just to make everyone understand.
So before that,
Yeah.
now in this example, the goodwill amount is 0.
Correct.
So if the goodwill amount are negative or positive,
Yes.
how you will
See, goodwill you should know. It is an example for intangible asset. Correct. Intangible asset is one item under non-current asset.
Yes.
So here you have.
under
If it's a positive one.
under non-tangible assets.
Yeah, but if it's a negative one, so there's a different treatment that we will discuss later. At F3 that won't come. Okay? If it's a negative, that is like a what you call it's a capital gain, it's other income. So you treat it as an income which will not be in our syllabus. So clear? So let me talk about the steps. First thing, please see the ownership. When you see the question, check what is the ownership of the subsidiary. In this question, what is ownership?
100%.
100%. One thing. Then by reading that, you should know one thing, there is no non-controlling interest. Second thing. Third, I need to calculate the goodwill. So you should know the required steps. You should find out purchase consideration. In a shortcut or indirectly we say investment in the subsidiary. How much investment you have made? So that question giving you
1,300.
1,300. You take that. Then you have to make sure compare this with the net asset of the subsidiary. When I say net asset, that is the total of the equity. And important, total of the equity at the date of acquisition. For example, you see here my balance sheet date how much? When? 1st January 2011. Suppose if the question telling you prepare financial statement on 31st December 2011. So that is after how long the acquisition is? 12 months. So during this 12 months there could be some transaction, no? So that can have an impact on your profits. That's when post-acquisition profits are coming. So you have to find that out. So percentage, no NCI, investment and date of acquisition, these things you have to find out. Then you calculate, you put down the format for goodwill. Arrive the goodwill. Goodwill here is obviously 0. Number 2, you work out the consolidated reserves or return earnings. So you, based on that these information, you take the portion from the subsidiary to pay. After that, we prepare the balance sheet based on the normal understanding. Is that clear? Can I move on to the next question? What's the time now? 4. We'll pray answer and we'll continue.